Welcome to the research desk. What happens when a closure of Hormuz or some massive geopolitical shock permanently reprices energy risk? Sustained $100 plus oil isn't just it's not a commodity wobble. It's an event that simultaneously prints fortunes for producers while triggering inflation, demand destruction, and frankly, permanent industrial impairment everywhere else.
Yeah, the macro damage.
Right. Now, I represent the perspective that a sustained environment of high oil actually forces a massive, profitable reindustrialization, a pivot toward resilience, electrification, and efficiency.
And I represent the perspective that $100 oil acts as just a brutal global tax, one that causes compounding cost push inflation, crushes consumer demand, and creates this immense political blowback that completely overwhelms the logic of those green investments you're talking about.
Okay, so to begin, we have to establish the baseline reality here. We are not examining a temporary price spike, right? Not a transient supply disruption that resolves in a single fiscal quarter.
Right, not a blip.
Exactly. We are examining a regime where $100 plus oil becomes the sustained multi-year baseline. Because when the fundamental risk of energy is structurally repriced by the market, well, the architecture of entire global business models has to be repriced alongside it.
It absolutely does.
And there is a common ground we really must acknowledge right away, because it forms the foundation of this entire analysis. Sustained high prices trigger an immediate, violent global income transfer.
Yeah, that is exactly the right starting point. We really need to look at this mechanism closely. I call this the income transfer machine.
The income transfer machine. Walk me through that.
So when oil stabilizes above $100 a barrel, purchasing power is violently and mechanically shifted across the globe. It moves from importing countries directly to exporting countries.
Right.
It shifts from fuel-consuming industries like global aviation and heavy agriculture directly to fuel-producing industries. And most critically, for the broader macroeconomy, it shifts from the disposable income of households into the capital expenditures of energy systems.
I mean, it's a zero-sum extraction in the short term.
Exactly. Consider the physical reality of this mechanism. A sovereign wealth fund in the Gulf suddenly receives billions of dollars in capital. A week prior, that exact capital resided in the bank accounts of the European or, the Asian middle class.
Yeah.
That is not a neutral economic event. It is a fundamental reorganization of global wealth. And the mechanism by which this wealth is extracted from the global economy, well, it's the inflation channel.
Right. So let us examine the exact transmission of that inflation channel, because it operates with terrifying precision. It is not some abstract macroeconomic concept. It is a physical supply chain reality.
Precisely. The pipeline of inflation is entirely mechanical. Oil feeds diesel. Diesel feeds freight. Freight feeds food, manufactured goods, and critical services. The shock does not stay neatly contained within the energy or commodities markets.
It bleeds into everything.
It leaks directly into the broader economy, yes, which pushes central banks into the ultimate trap. When that inflation registers in the core consumer price index, central banks are forced into the worst possible policy trade-off.
Because they have to hike.
They must either tolerate runaway, compounding inflation that destroys fiat purchasing power, or they must tighten monetary policy into an environment of already weakening economic growth. The inevitable mathematical result is slower gross domestic product, radically tighter financial conditions, and a widening dangerous divergence between commodity exporters who are flush with cash and commodity importers who are starved of it.
Look, while the mechanics of the inflation channel are undeniable, focusing solely on the macroeconomic penalty fundamentally misses the structural response of the market.
How so?
Because this isn't just a commodity story, it is a capital allocation story. When fossil energy becomes structurally expensive and geopolitically insecure, investment capital does not simply sit idle and absorb the punishment.
Sure, it reacts.
Capital is Darwinian. It floods into the specific systems that allow economies to function with less oil. We see an immediate, aggressive migration of capital into energy efficiency, electrification, modernized grids, battery storage, industrial automation, you name it. Digital optimization systems.
Okay, but
To truly understand the scale of this physical restructuring, we must look at the clearest modern template we have, which is Europe's 2022 energy crisis.
Well, the European fossil fuel shock is definitely the perfect laboratory for this dynamic.
It really is. So let us walk through exactly what happened. In 2022, Brent crude broke well above $120 a barrel following Russia's invasion of Ukraine, and the wider energy complex, particularly natural gas, just exploded in tandem.
Right.
Now, look at the exact documented response of Germany's chemical giant, BASF, specifically their flagship Ludwigshafen complex.
The massive one?
Yes. We need to understand what Ludwigshafen actually is. It is not just a factory. It is the world's largest integrated chemical complex. It's a sprawling industrial city covering 10 square kilometers, where the byproduct of one facility feeds directly into the feedstock of another.
It's an ecosystem.
Exactly. And for decades, the foundational assumption of this massive complex was an uninterrupted, practically infinite flow of cheap Russian pipeline gas. Natural gas was not just their power source. It was the literal chemical feedstock for their ammonia and fertilizer production.
Right. The baseline assumption of their entire business model was cheap energy.
Exactly. When the shock hit and the pipeline gas was cut off and repriced at astronomical liquefied natural gas rates, BASF did not simply absorb the margin hit, take out a bridge loan, and hope for a reversion to the mean.
No, they couldn't.
They fundamentally changed their global corporate architecture. They immediately cut energy-intensive operations in Europe, shutting down specific ammonia plants. They accelerated radical efficiency measures across their surviving European footprint.
Right.
But more importantly, they redirected massive future capital investment toward less energy-vulnerable regions, specifically deploying billions into new, modernized facilities in China and the U.S. Gulf Coast.
Wow.
And ultimately, they announced the permanent structural downsizing of the Ludwigshafen complex. This is the ultimate template for the bull case of adaptation. High fossil energy prices do not merely enrich producers in the short term. They permanently impair fragile industrial assets and redirect global capital flows for years to come.
Sure, but
As proof that industrial giants will ruthlessly re-architect their entire existence, abandon legacy assets, and build highly efficient new infrastructure rather than pay the new energy tax indefinitely.
look, that's a compelling argument, but let me push back on that. Is that actually capital redirection, or is it just capital destruction disguised as adaptation?
It's adaptation to a new reality.
You frame the BASF example as a triumph of strategic agility and forced evolution. But I look at the exact same data regarding Ludwigshafen, and I see the permanent deindustrialization of a continent's economic engine.
I mean, it's painful, yes.
A plant downsizing of that magnitude is a profound loss of baseline industrial capacity. It is a loss of thousands of highly skilled jobs, and it is the absolute destruction of billions of euros of previously invested capital. Moving a chemical plant to a different continent because you can no longer afford the energy to run it locally is not an upgrade to the global system. It is a desperate salvage operation.
But it proves the capital will move to efficiency.
But I understand your broader point regarding the forced reindustrialization thesis. Let us examine the mechanics of your bull case.
Right, so the thesis is the forced reindustrialization of resilience. The core argument here is not that high oil is inherently good for the global economy. I admit it is painful. But the argument is that the pain sparks a durable, multi-trillion-dollar investment supercycle, designed specifically to escape oil dependence.
Okay, let's walk through that.
Let us start with the first-order winners, the entities that accumulate the capital required to fund this supercycle. That happens right at the wellhead. At $100 plus oil, upstream producers and oil field services firms enjoy staggering direct cash flow windfalls. The economics of exploration and production shift violently upward.
Naturally.
Historically, we have exact data on how this repricing works. In periods of sustained high-price regimes, oil field services firms see their enterprise value to EBITDA multiples expand by 15 to 20% above their long-term historical averages. Furthermore, Their returns on invested capital routinely climb past 15 to 20%.
Well, the margins expand because the underlying asset is suddenly treated as scarce rather than abundant.
Precisely, the raw profit motive unleashed by a repriced commodity turns these firms into modern-day Daniel Plainviews from the film There Will Be Blood.
Ah, that's a good comparison.
Right? In that narrative, we see the absolute ruthless extraction of value driven by an insatiable demand for a critical resource. When the system suddenly demands every available barrel to keep the lights on and the supply chains moving, the entity controlling the drill bit dictates the terms of reality. The first money gets printed closest to the wellhead, and it generates the massive free cash flow that eventually sloshes into the rest of the market.
Okay, the wellhead economics are undeniable. If you are lifting the barrel, you are capturing the premium. But that windfall is highly concentrated in a specific geography and a specific sector. It does not naturally transition into widespread economic resilience.
I completely disagree. It absolutely expands into critical logistics and security. Consider the global tanker market in the defense sector. In a sustained geopolitical energy crisis, a tanker stops being just a maritime vessel. It becomes what we must classify as a moving bottleneck asset.
A moving bottleneck asset.
This is a critical analogy to grasp. When supply chains fragment due to sanctions, war, or infrastructure sabotage, buyers are forced to seek replacement barrels from much further away. This radically increases ton miles.
The volume of oil multiplied by the distance it must travel.
Exactly. A voyage that used to take 5 days from Russia to Rotterdam now takes 40 days from the Middle East or the U.S. Gulf Coast. Longer routes tie up the global fleet. Soaring insurance costs for navigating hostile waters add massive premiums. The strategic scarcity of available ships converges to lift charter rates exponentially. The asset itself, the physical steel in the water, becomes a strategic choke point that prints money.
And you're saying the defense sector experiences a similar dynamic?
A simultaneous windfall. And we are not just talking about traditional military hardware, kinetic weapons, or shipbuilding. An economy attempting to run on highly fragile, rerouted, and strained energy networks requires massive digital shields. We see immediate capital flows into cybersecurity, satellite surveillance, and critical infrastructure protection.
Right.
The pipeline operator who previously viewed cybersecurity as an IT expense suddenly views it as core operational survival.
Look, you are describing the short-term beneficiaries of chaos. Tankers and defense contractors making exceptional margins during a crisis does not equate to a long-term structural reindustrialization.
But I am describing the prelude to the deep bull case. The profound lasting shift occurs in capital expenditure migration. Structurally expensive oil fundamentally changes corporate payback periods.
Go on.
An energy efficiency investment, say a massive heat recovery system in a manufacturing plant, that looked marginal or speculative when oil was at $70 a barrel, becomes an absolute boardroom mandate at $100 a barrel. The math flips from an 8-year payback to a 2-year payback.
Okay, I see what you mean.
And we have the exact data on this capex pattern, indexed to a fourth quarter 2021 baseline of 100. Illustrative comparisons under a sustained $100 plus oil regime show national energy grid digital infrastructure investment rising to 135.
Wait, walk through the specific mechanics of that index growth. Why does grid infrastructure jump to 135?
Because when baseline power is intensely expensive, you can no longer afford transmission losses. You invest heavily in smart grid technologies, dynamic load balancing, and automated substations to ensure every megawatt generated actually reaches an end user.
Right, waste becomes intolerable.
Exactly. Let us look at the other indices. Hyperscale data center energy management spending surges to 140.
140.
Yes. These facilities consume massive amounts of power for cooling. When power costs spike, investing in liquid cooling systems or AI-driven thermal optimization isn't just a sustainability initiative, it is the only way to protect the operating margin. Logistics and shipping digital investments rise to 120 to optimize routing and fuel consumption, Manufacturing digitalization hits 118. Across the board, optimization stops being an optional luxury and becomes a survival imperative.
Yeah, but you are mapping out the software and infrastructure response.
I am mapping out physical adaptation. Consider the shipping industry itself, specifically the 2022 pivot made by Maersk, the global shipping giant. Facing record bunker fuel prices, the heavy unrefined oil that powers massive container ships, Maersk did not just hedge their financial contracts and wait for prices to fall.
No, they took action.
They committed billions of dollars to order a completely new fleet of methanol-enabled vessels. They completely redesigned the propulsion architecture of their core assets. This was not a public relations exercise in climate branding. It was a rigorous strategic adaptation designed to convert raw fuel volatility into controllable balance sheet risk.
Sure.
By moving to methanol, they changed the nature of their dependency. Under energy stress, capital expenditure migrates violently toward any technology that converts unhedgeable fossil exposure into controllable software, electricity, or baseline efficiency.
Okay, but here's what really worries me. You're painting a picture of elegant transition, but history shows us this is usually a desperate scramble for survival.
It's not always elegant, but it happens.
You are describing the world as a frictionless spreadsheet where a higher input cost smoothly triggers a rational capital allocation into next-generation technology. The reality of $100 oil on the ground is a blunt force trauma to global growth. It is strictly a tax on the global economy.
A tax?
Yes. And taxes slow growth, restrict capital, and break supply chains long before they fund any kind of technological renewal.
Well, walk through the specific mechanisms of that tax. How does it break the system before the system can adapt?
There are 4 distinct transmission mechanisms that guarantee severe macroeconomic damage. The first is cost-push inflation. We touched on this briefly, but the mechanics demand intense scrutiny.
Right. The diesel leak.
Exactly. Oil raises fuel prices. Fuel raises logistics and transportation costs. Logistics raise the cost of agricultural production, manufactured goods, and basic services. The leak from the wholesale price of diesel to the retail price on the supermarket shelf is direct and unforgiving. Diesel is the ultimate culprit here because it is the working fluid of the physical economy.
Yes, it is.
It links crude oil extraction directly to freight rail, long-haul trucking, mining excavators, and heavy industry. The shock fundamentally refuses to stay contained in the commodities market.
You are describing the absolute pass-through effect of the energy supply chain.
Exactly. Which brings us to the second mechanism, demand destruction. We have to look at the psychology and reality of the consumer. Households do not consume a barrel of Brent crude. They consume the act of commuting to work, the heating and cooling of their homes, their weekly groceries, and discretionary retail purchases.
Right.
As the embedded energy costs in all those activities rise, disposable income immediately plummets. In debt-heavy consumer economies, this translates instantly into weaker retail spending. Families stop going out to eat, they cancel vacations, they delay purchasing appliances.
Which kills velocity.
Yes, and in high-saving economies, it triggers intense precautionary saving, pulling even more velocity out of the financial system as citizens brace for a prolonged recession. Either way, aggregate demand softens violently.
And the central banks are structurally mandated to react to the inflation, not to the drop in consumer demand.
That is the third mechanism, and it is the most lethal: monetary tightening. Confronted with persistent, energy-driven inflation that is leaking into wages and core goods, central banks are forced to keep interest rates higher for longer, even as the real economy slows down around them.
A brutal trade-off.
This is how the physical oil shock moves from the gas pump directly to the bond yield curve. Higher interest rates then cascade through the financial system. They crush housing markets by making mortgages unaffordable. They stall corporate capital expenditure because the cost of borrowing capital for those very efficiency projects you highlighted becomes prohibitive.
That's a fair point on the capex cost.
And they trigger refinancing crises for weaker corporate credit profiles who hold floating rate debt. The macro damage broadens from localized sector pain into an economy-wide deceleration.
Okay, and the global trade imbalance.
That is the fourth mechanism. The terms of trade. There is a brutal mathematical divergence between energy exporters and energy importers. This is profoundly dangerous for emerging markets. A country that relies on imported oil must now pay much more for that oil. Because oil is priced in US dollars and high rates strengthen the dollar, their local currency buys even less oil.
A double hit.
Exactly. They face a stronger dollar and a higher energy import bill simultaneously. It is how a simple commodity shock transforms into a sovereign balance of payments crisis, forcing governments to deplete their foreign exchange reserves just to keep the lights on.
Look, the macroeconomic theory is sound, and the transmission mechanisms are clearly defined. But we need to see how it operates at the industry level to understand the true scale of the friction you are describing. Give me the physical reality of this destruction.
The industry-level carnage is absolute, and it leaves permanent scars. Let us look at the 2008 airline liquidity crisis as the cleanest historical cautionary tale of what happens when adaptation cannot outpace destruction.
2008.
Yes, in the summer of 2008, crude surged toward an unprecedented $147 a barrel. The baseline mathematical models for the global aviation industry broke instantly. Historically, jet fuel represented a manageable 25 to 35% of an airline's operating expenses.
Which is standard.
Right. Within a matter of months, that figure spiked to a crippling 40 to 50%.
Meaning the fundamental operating leverage of the business inverted. Every time a plane took off, it was essentially burning through the company's equity.
Precisely. This was an immediate existential liquidity crisis. Carriers like American Airlines had no time to execute an elegant transition plan. They could not simply order highly efficient next-generation aircraft and wait 5 years for delivery.
Right, you can't build a new plane overnight.
They were bleeding cash daily. Their response was survival through amputation. They slashed unprofitable routes, effectively cutting off smaller cities from global commerce. They grounded massive portions of their older, less fuel-efficient fleet, abandoning millions of dollars in capital assets to the desert.
Just park them.
Parked them, and famously, they invented the baggage fee. They stripped the product down to its studs just to generate immediate, non-taxed ancillary revenue to stay alive. It was not a technological upgrade of the aviation sector. It was pure, unadulterated carnage that degraded the product and shrank the industry footprint. Energy-intensive manufacturing, chemical production, and heavy agriculture suffered the exact same margin compression.
Yet the counter-argument is that in that exact same scenario, the high price is the ultimate market signal. It forces the market to ruthlessly eliminate inefficiencies, create more supply, or invent a viable alternative.
Eventually they do. The reality of political survival is that governments invariably double down on fossil security. When voters are furious about energy costs, politicians do not promise them a smart grid in 10 years. They mandate more immediate drilling.
Sure, the short-term response.
They stockpile strategic reserves, creating artificial demand that pushes prices even higher. They intervene in free markets with price controls, fuel subsidies, and export bans, all of which distort the market signals you are relying on. They entrench hydrocarbon dependence rather than escaping it. And even the specific sectors you identified as winners can quickly become catastrophic capital traps.
Explain the mechanism of the trap.
Look at the compounding crises of the 1970s. We experienced the initial 1973 Arab oil embargo and the subsequent 1979 Iranian Revolution energy shock.
The twin shocks.
Yes. Initially, the strategic urgency of securing oil, combined with soaring charter rates, led to massive orders for maritime oil tankers. Shipyards globally were overwhelmed with an influx of capital to build these moving bottleneck assets. It looked like a permanent supercycle.
Because the ton miles exploded.
Exactly. But the wider global economy was simultaneously slowing down under the immense weight of the energy tax. The high prices caused aggregate demand for oil to shift downward. By the time those newly built supertankers slid into the water, the fundamental supply-demand balance had broken.
Demand fell out from under them.
The newly built supply of vessels vastly overshot the actual need for transportation. Those state-of-the-art supertankers were delivered directly into a recessionary void. Many were sailed straight from the shipyard to Norwegian fjords where they were laid up to rot, or they were scrapped years ahead of schedule. A crisis winner becomes a long-term, wealth-destroying trap when the underlying economic system it serves breaks underneath it.
Okay, we have rigorously explored the digital resilient bull case in the macroeconomic destruction bear case. But looking at the historical data and the market mechanics, we converge on one unavoidable reality. The most critical transmission channel in a sustained $100 oil environment isn't strictly economic and it isn't technological. It is political.
I agree entirely. Policy completely overwhelms logic.
It really does. High oil changes governments and governments change markets. You can build a perfect discounted cash flow model for a regulated utility, an upstream oil producer, or an electric vehicle manufacturer. You can model their cost of capital, their expected margins, and their technological roadmap perfectly.
Right.
But in a true sustained energy shock, the timeline of politics supersedes the timeline of capital. Political survival operates on a cycle of weeks and months, not years and decades. Policy interventions like massive consumer subsidies, retroactive windfall taxes, coordinated strategic petroleum reserve releases, and sudden export controls can ruin your meticulously crafted DCF model overnight.
In a heartbeat.
If an energy producer enjoys a massive, unexpected windfall because oil spikes to $120, the state will inevitably seek to expropriate a significant portion of that through windfall taxes to shield furious voting consumers.
And it is vital to understand that those furious consumers react fundamentally differently depending on their geography and their cultural baseline. We have to look deeply at the cross-cultural multipliers of an energy shock.
The regional differences.
Exactly. $100 oil does not land the same way in Tokyo as it does in Texas. The transmission mechanisms adapt to the culture. In Japan, a nation heavily reliant on imported energy, a price shock reinforces a deep historical cultural frugality.
They conserve.
It drives immediate, widespread demand for extreme home appliance efficiency, a reduction in industrial waste, and a further optimization of their already robust, localized public transit networks. The society tightens its belt collectively. In China, a culture with historically high savings rates interprets the macroeconomic shock as a signal of broader instability.
So they stop spending.
Yes, it prompts citizens to intensify their precautionary savings. They immediately withdraw liquidity from the retail and property economy and lock it away, severely dampening domestic consumption.
But in the United States, the dynamic is entirely different. It is a direct, violent hit to discretionary retail spending because the economy is uniquely structured around vast distances, suburban sprawl, and the personal automobile.
Let me break down the precise kitchen table economics of this dynamic, because the 2008 Ohio suburban household remains the absolute clearest micro-macro bridge we have to understand this phenomenon.
Walk us through the numbers.
Let us look at the exact numbers. In 2008, the retail price of gasoline climbed rapidly from under $2 a gallon to well over $4 a gallon. Let's examine a standard two-income family living in the suburbs of Ohio, driving two vehicles to separate jobs.
Very typical scenario.
Their fixed, unavoidable monthly fuel bill jumped from roughly $200 to over $400. Now consider the concept of the marginal dollar. That extra $200 did not just vanish into an abstract economics textbook.
It came from somewhere.
It had to be physically extracted from their existing household budget. And because mortgage payments and utility bills are fixed, that extraction came directly out of discretionary spending. It came immediately out of Friday night restaurant meals, weekend entertainment, canceled family trips, and delayed home repairs.
And that scales.
Exactly. When you multiply that highly localized $200 extraction by tens of millions of suburban households across the country, you realize that an energy effect is actually a retail recession and a housing recession disguised as a commodity spike.
That is the perfect synthesis of the macro impact. The pain is localized, but the effects are systemic. Look, the modern economy is not perfectly insulated from this dynamic, but we must acknowledge that it possesses structural shock absorbers today that simply did not exist during the embargoes of 1973 or even the financial crisis of 2008.
We have better tools now.
We do. We have radically better baseline energy efficiency in our engines and factories. We have much deeper, more sophisticated financial markets to hedge risk. We have profound digital optimization tools, and we have mature deployable alternative technologies like solar, wind, and grid-scale batteries.
True.
The hit to the global economy is not eliminated by these tools. The trauma is still real, but it is bifurcated. It creates a stark, permanent division between those entities who can utilize these tools to adapt and those who cannot. This brings me to the ultimate framing of this entire analysis. It is the concept of the hidden subsidy exposed.
Explain the exact mechanism of the hidden subsidy. This is the crux of the issue.
For decades, structurally cheap oil was quietly underwriting global competitiveness. It was an invisible line item on every corporate balance sheet. An industrial manufacturing plant, a sprawling airline logistics network, or a massive suburban retail distribution model appeared hyper-efficient, highly profitable, and globally dominant.
But it was propped up.
Their dominance was an illusion. $100 oil removes the mask. It fundamentally reveals which business models were actually built on superior management, lean operations, and genuine innovation, and which business models were secretly just a massively leveraged bet on inexpensive, uninterrupted fossil energy.
That is a stark way to look at it.
When the geopolitical environment permanently removes that subsidy, the true structural integrity of the business is exposed to the harsh light of reality. So, to navigate this new paradigm, we have developed 7 specific, practical implications. We must walk through exactly how to operationalize this understanding in a real-world environment.
Let's do it.
I will outline the first implication. Separate time horizons aggressively.
How do we separate them?
You must treat upstream oil exploration, oil field services, selected maritime tanker exposure, defense contractors, and physical gold as near-term immediate beneficiaries over the next 6 to 12 months. They capture the initial shockwave of capital. But you must not confuse first-order crisis-driven cash flow with a durable structural economic advantage.
Right. The trap we discussed.
Exactly. You must set explicit, unemotional triggers to rotate capital out of these sectors. Those specific triggers are global crude oil holding below $80 a barrel for 2 consecutive fiscal quarters, or global oil demand growth being officially revised down by more than 1% quarter over quarter for 2 consecutive quarters.
Those triggers are absolutely critical because they prevent you from holding a cyclical crisis asset straight into a structural macroeconomic decline, exactly like the 1970s tanker bust we discussed. Let me analyze the second implication. Stress test all oil-consuming business models immediately.
Every single one.
For sectors like commercial airlines, heavy chemicals, long-haul trucking, shipping users, industrial mining, and agriculture, you can no longer rely on trailing historical financial metrics. They are obsolete. You must rerun all corporate assumptions and financial models at a Brent crude baseline of $100 to $120.
It has to be the new baseline.
Furthermore, you must explicitly model full diesel pass-through costs and assume that central bank interest rates stay higher for much longer than the market anticipates. You must prioritize the firms that possess the pricing power to aggressively hedge their exposure, surcharge their customers without destroying demand, physically reduce their fuel intensity, or substitute out combustion for electricity.
And if they can't?
Conversely, you must ruthlessly derate any firm that lacks those operational levers.
The third implication focuses on identifying the exact vector of the inflation. Track diesel, not just crude.
Crucial distinction.
While the financial media focuses obsessively on the headline price of Brent or WTI crude oil, the real economic transmission runs directly through the physical diesel market into freight, agriculture, and industrial operating costs.
The working fluid.
Right. You must build specific analytical dashboards that monitor refined diesel crack spreads, agricultural fertilizer input costs, and global maritime freight rates alongside the baseline crude price. These are the specific, localized channels through which inflation actually leaks into retail food prices, manufactured goods, and the household budgets we discussed in Ohio. Tracking headline crude is insufficient for understanding macro damage. The refined diesel spread is the actual mechanism of economic pain.
And while tracking that specific mechanism of pain, you must execute the fourth implication: overweight resilience capex beneficiaries.
The adaptation plays.
You must focus your capital allocation on the entities building the escape routes. Over the next 12 to 18 months, prioritize investments in modernized electrical grids, large-scale battery and thermal storage, advanced power electronics, industrial artificial intelligence for process optimization,
Smart grid management software, digital twin simulation technology, data center cooling optimization.
right, sovereign cloud infrastructure for critical national security, battery supply chains and industrial material recycling. The central unavoidable insight here is absolute. Energy optimization ceases to be a luxury green branding initiative and becomes critical, strategic, national infrastructure the very moment geopolitical oil risk is permanently repriced.
Okay, the fifth implication moves our analysis from the corporate level to the sovereign level. Map terms of trade vulnerability country by country. As we established, oil exporters gain immediate fiscal breathing room and massive capital inflows. Oil importers face terrifying current account deficits and intense currency stress.
It's a massive divergence.
You must analyze and rank sovereign jurisdictions by their specific energy import dependence, the crushing weight of their domestic fuel subsidy burdens, and their political and cultural tolerance for fuel price pain. This rigorous analysis is especially important when evaluating oil importing emerging markets that are dealing with inherently weak local currencies and dollar-denominated debt.
Which leads directly into the sixth implication: recognizing that sovereign stress creates erratic government behavior. Model policy risk as a core variable, not an academic footnote.
You can't ignore the politics.
In your financial models, you must build rigorous quantified scenarios for the introduction of consumer fuel subsidies, retroactive corporate windfall taxes, coordinated strategic petroleum reserve releases, abrupt export controls, emergency electric vehicle incentives, utility tariff reform, and massive defense spending shifts.
It all happens at once.
In a sustained energy shock, the desperate electoral response from a panicked government facing inflation riots can completely overwhelm your fundamental bottom-up corporate valuation logic within a single budget cycle. If you are not modeling the political reaction function, you are flying blind in a storm.
And finally, the seventh practical implication. Use the BASF Ludwigshafen experience as the ultimate industrial template. Any energy-intensive manufacturer in your purview must be aggressively evaluated on 3 specific existential questions within the next 12 months.
What are the 3 questions?
Question 1. Can the company physically relocate its most vulnerable production facilities to a cheaper energy jurisdiction? Question 2. Can the company rapidly digitize and automate its physical processes to significantly reduce its baseline energy intensity? And question 3, can the company structurally alter its supply chain to source feedstocks from less fragile, more secure energy systems?
Relocate, digitize, or substitute?
Exactly. If the answer is no on all 3 of those questions, the issue facing the company is not a cyclical margin squeeze that will eventually resolve. It is a structural, permanent impairment of their business model.
While we have laid out the intricate mechanics of the income transfer machine, the immense profitability of moving bottleneck assets, the devastating taxation effect on global consumption, and the inevitable political blowback that distorts free markets, we covered a lot of ground.
Reviewing the evidence, we can agree to disagree on whether the ultimate primary legacy of $100 oil is the incredible forced technological leap forward toward grid resilience, or the permanent widespread economic scarring left in its wake. But we share a clear, unified, and undeniable verdict on the fundamental mechanism itself. Destruction and adaptation do not happen in sequence.
They arrive together.
They are inextricably linked, and they are completely inseparable.
The reality of the situation is exactly as our underlying research concludes. Cheap oil made many industries look stronger than they were. $100 oil reveals the truth. As the geopolitical map continues to fracture along fault lines of energy security, The most critical question isn't simply whether your investment portfolio can survive a baseline of $100 oil. The real question is whether your entire underlying business model was secretly just a massively leveraged bet on cheap fuel all along. This is the Research Desk officially signing off.